So, there's a new economic report out on India, and a single number is making everyone, especially investors, sit up and pay close attention. Let's break down exactly what that number is and what it really means for the road ahead. And here it is, $12.3 billion. That's the size of India's current account deficit for the second quarter of this fiscal year. And wow, that is a sharp, significant jump from the last quarter, which is exactly why it's prompting a fresh look at the country's economic stability. So this leads us to the big question, right? Is this just a temporary blip on the radar, or is it a genuine warning sign for India's economy? For any serious investor, understanding the answer to that is, well, it's pretty critical. All right, so let's really get into it. To understand the risk here, we first need to get a solid handle on what this $12.3 billion figure is all about. The current account deficit, or what you'll often hear called the CAD, is basically the country's bank statement with the rest of the world. A deficit simply means India is spending more foreign currency than it's bringing in. It's one of the most fundamental indicators we have of a nation's external financial health. Now, why does this one metric matter so much for investors? Because a high CAD that sticks around for too long, usually above that 2 to 2.5% of GDP danger zone, can really start to cause problems. It can hurt the country's credit score, weaken the currency, and just signal deep economic vulnerability. Now, we're not in the danger zone yet, but it's the speed at which this deficit is growing that's got everyone's attention. So, how did we get here? I mean, a deficit like this doesn't just happen on its own. It was pushed wider by two really powerful and actually very different economic forces. The first issue is kind of a long-term structural one. Just look at the numbers. Goods imports are sitting at nearly $200 billion, while our exports are almost half that. This massive trade gap is a persistent drag on the current account, and it's being fueled by things like a global slowdown. The second driver, though, is much more immediate and, you could argue, a lot more problematic. Gold imports, they surged by an astonishing 150% in a single quarter, hitting $19 billion. This isn't just another import. The way gold hits the economy is unique. And here's why that's such a critical distinction. See, not all imports are created equal. When India imports oil or machinery, those are productive imports. They literally fuel factories, power the economy, and help create things for future exports. Gold, on the other hand, is what we call an unproductive import. It takes valuable foreign currency and turns it into an asset that just sits there. It contributes very little to actual economic growth. Okay, so what happens when you have this widening deficit that needs to be funded, but the money you usually use to fund it isn't flowing in? Well, you get a stability shockwave, and the ripple effects can be pretty serious. This right here, this is the real uh-oh moment in the data. Normally, that current account deficit gets paid for by a surplus in the capital account, which is just a fancy way of saying foreign investment flowing into the country. But in the second quarter, that surplus just collapsed. It went from $8 billion down to just $600 million. Poof. The money needed to bridge the gap simply wasn't there. Think about it like this. It's like dipping into your personal savings to pay the bills every month because you took a pay cut. When those capital inflows dry up, the Reserve Bank of India is forced to step in and sell dollars from its foreign exchange reserves to cover the shortfall. It's a move you can make in the short term, but it's definitely not sustainable if it keeps happening. So you can see how this creates a chain reaction, right? It's like a line of dominoes. The deficit gets wider, the capital inflows dry up, which forces the RBI to sell its own dollars to fill the gap. That depletes the country's Forex reserves, and finally, that puts direct downward pressure on the value of the rupee. And here is the tangible result of all that pressure. The national savings account got drawn down by nearly $1 billion last quarter just to manage the deficit. Now, that number itself isn't catastrophic, but it's the trend that matters here. The consequence for businesses and investors is pretty clear: more currency volatility. A weaker rupee, likely bouncing around in that 88 to 91 per dollar range, makes critical imports more expensive and increases the cost of paying back any foreign debt. But okay, the picture isn't all negative, not by a long shot. The Indian economy has some significant strengths that are acting as really crucial shock absorbers against these pressures. The first big, bright spot is the absolute powerhouse that is India's services sector. Net services exports, driven by things like IT and business services, grew a really robust 14%.
This remains a powerful and consistent engine for earning foreign currency, and it provides a vital cushion.
And the second cushion is remittances. That's the steady flow of money sent home by Indians working abroad. It provides billions in stable dollar inflows. This is great because it not only supports the current account directly, but it also boosts spending right here at home. So let's bring all this together. With the challenges and the cushions in mind, what's the revised forecast and what are the key signals investors should be watching for a potential recovery? Well, no surprise, the outlook has become more cautious. The full-year forecast for the current account deficit has been revised upwards to 1.4% of GDP. This really just reflects the expectation that high gold imports and weaker exports are probably going to weigh on the numbers for the rest of the year. For anyone watching the markets, these are the 4 key indicators to look for. Think of it as your turnaround checklist. Any sign that goods exports are stabilizing, that gold imports are cooling off, and, this is the big one, that foreign investment is starting to flow back in, well, that'll signal that the worst may be over. And this brings us right back to our final question. Are we just looking at a temporary cyclical dip that's been caused by global headwinds and a weird spike in gold demand? Or does this reveal a deeper structural risk to India's economy? While the pressures right now are significant, the country's long-term strengths are still very much intact. The real key for investors will be distinguishing that short-term turbulence from the long-term trajectory.